In the obsolete world of finance, there are two main ways of alternative funding. The first is internal equity financing, a form of partnership and investment. The second one is external debt financing, a form of borrowing to finance the new venture. In this video, I will explain the two main ways of alternative funding and their differences. In addition, I will explain what capital base means and the types of protection for new businesses and inventors. Equity financing comes as either common stock or preferred stock of investors, which can be either from inside or outside the company, like shareholders. Both are entitled to a return on their investment in the form of dividends for the common stock shareholder or a fixed rate of dividend for the preferred stock shareholder of either a new startup or an existing one. The difference between them is that the common stockholder has voting rights on decisions to be made in the business, but no enforced claim to dividends. They do not come first to get profit. In other words, they have to cover their obligations first, such as suppliers' accounts payable, the payment of any loans with interest, and all incurred expenses of that period. If there is profit, it will be divided among common stock shareholders. On the other hand, the preferred stock does not have to cover their obligations first, like suppliers' accounts payable and the payment of any loans with interest and all incurred expenses of that period. If there is profit, it will be divided among common stock shareholders. However, the preferred stock does not have voting rights if there is sufficient profit. Sources of equity financing can come from different parties that have an interest in new business, such as and mostly from owner equity, family and friends, small business investment companies, employees, customers, and bartering, which is the act of exchanging items of equal value. Debt financing is mostly borrowings and loans of all kinds and sorts, long, medium, and short terms, such as mortgage loans, chattel mortgage loans, asset loans, and bonds. The securities of the loan can be sold to the public or privately placed with several lenders, which have standard ways of methods of interest payment and repayment. Sources of debt financing can also come from different parties, such as commercial banks, insurance companies, credit cards, and small business administration, which provides guaranteed loans and specialized programs. The major difference between equity and debt financing is that in equity, other people share and reduce the risk of the new startup business not having or making any profit by not having to repay and provide interest for the shareholders' investment. This can be expensive and can share or take a huge amount of profit, as well as they can share and have rights to make decisions with changes to your startup business if the new venture is profitable. On the other hand, debt financing is less expensive, but as the owner, you have to repay the debt with the principal interest rate on it, regardless if the new startup business is profitable or not. What is a capital base? Well, it is the total of current and non-current assets less the total of current and non-current liabilities that businesses use to produce goods and services and gain total equity in accounting terms. In applying the capital base of total assets to the new business, it looks like the current assets of professional people and teams are not enough as capital to produce the business or service that consumers and business-to-business customers need and want. Therefore, the new venture will need more current and fixed assets to carry out its liabilities. First, the current assets that the new business needs are one of the most important elements for the success of any new venture, which is cash to operate and pay for wages payable, lease premises and pieces of equipment, and so on. Next, some setup procedures and documentation are needed, such as invoices, receipts, etc., to deal with customers, creditors, and suppliers in the form of either accounts receivable or payable, distributors, and sometimes delivery service to provide sales and delivery to customers of the new business, whether it's a product or service business to be done. Now those people, employees, that entrepreneurs and new business owners work with and the fixed conditions are essential as current assets. They need fixed or non-current assets, such as suitable places and facilities, to work and carry out their function, which has to be in good working conditions and environmentally friendly. Next, the new venture needs some equipment or services for those professionals to bring innovative business products or services into reality. Next, the new venture needs furniture, such as chairs, tables, and other fixed assets, as part of the capital base that this innovative new venture needs, which entrepreneurs don't know about. It's an important part of their capital based on their lawful rights to keep and benefit from them. It's important to prevent anyone from stealing, copying, or using it without the original entrepreneur's permission. Goods and services consist of 4 major rights in which they have to be licensed and dealt with in different ways, such as trademarks, which are seen as distinctive marks or signs that differentiate your goods or services from others that include logos, slogans, straplines, and symbols, for example, the Honda logo. Patents are protection for inventors that give them a monopoly over their goods and services or processes in which others need your permission and license before they use the patent of your inventive goods or services. Copyrights are the rights assigned automatically to you as creators or publishers. They apply to artistic, literary, musical, and software output, drawings of your plans or products, and sketches of your ideas. Design rights are similar to copyrights and automatic rights, but the difference is the requirement of establishing document registration because of the grace period that they possess. Starting a new venture is hard nowadays, especially for new starters unfamiliar with business funding. However, knowledge of the 2 main ways of alternative financing and their differences can make the difference between success and failure. Knowing what capital base means and the types of protection for new businesses and inventors is also as important to be familiar with. Happy journey ahead, and hoping to see you on the other side. Read more articles and stories from ShqairCom on Medium and LinkedIn. Please leave any comments or suggestions you may have. I would be delighted to receive them at any time. If you enjoy the video, kindly give it a few applauses, highlight it, and subscribe. Feel free to share the video at any time. To all of you, happy day or night.